The global financial system is currently facing an invisible bottleneck that traditional news cycles refuse to cover because it exposes a terminal vulnerability in sovereign debt markets. While retail speculators waste months tracking short term chart patterns and waiting for public court rulings, central banks and institutional clearinghouses are quietly restructuring their risk models to survive a structural paradigm shift. The true crisis has nothing to do with market sentiment or retail buying volume, but rather the hard math governing Tier 1 capital compliance under stricter international banking rules. If you continue to judge the health of digital assets by the price action on public consumer exchanges, you are applying an outdated retail trading model to an institutional plumbing overhaul that operates on an entirely different timeline. By the end of this breakdown, you will understand the exact operational mechanism driving the modern flight to hard assets and how private distributed ledger routers are being actively configured to absorb trillions in sovereign liquidity when the legacy clearinghouses lock up. To understand why traditional market indicators are failing, we must first look at how the definitions of safe haven assets are being forcibly re engineered by central banks behind closed doors. For decades, sovereign debt instruments like government bonds were treated as the baseline fuel for global interbank settlement, providing the unencumbered liquidity needed to clear cross border corporate transactions. However, as global debt limits break and currency depreciation accelerates, these legacy fiat obligations are quietly being downgraded inside institutional risk models due to rising counterparty vulnerabilities. This structural friction has triggered a silent, aggressive accumulation of physical gold reserves by central banks determined to shore up their baseline balance sheets with assets free of default risk. But holding physical metal inside isolated vaults creates an immediate operational liability because it cannot be moved, split, or settled at the speed required by modern automated trading systems. The immediate bottleneck facing institutional clearinghouses is the structural inability to instantly verify and route the value of these physical reserves across separate international legal jurisdictions. When a Tier 1 banking institution faces a sudden margin call or a liquidity freeze, legacy settlement systems require days of bureaucratic clearing, physical auditing, and manual compliance checks to mobilize the underlying capital. This systemic delay creates an unacceptable layer of settlement risk that modern high-frequency financial plumbing can no longer tolerate, especially during periods of extreme macro volatility. As a result, the global financial elite are actively building an alternate infrastructure designed to transform illiquid physical collateral into instantaneous, high-velocity digital assets. The goal is not to eliminate traditional safe haven assets, but to unlock their underlying value by wrapping them inside programmatic legal frameworks that operate outside the control of legacy commercial banks. This brings us to the core operational reality that retail investors completely overlook: the impending transition from paper-based financial derivatives to real-world asset tokenization. The global financial reset is not an ideological shift toward decentralized currency, but a calculated institutional upgrade to ensure capital preservation for multifamily offices and central banking networks. By utilizing permissioned enterprise-grade distributed ledgers, institutional actors can instantly verify ownership, enforce compliance rules, and route multi-billion-dollar capital pools across borders in seconds. This structural migration is completely detached from retail market speculation, meaning the plumbing is being laid while public spot markets remain artificially flat. To survive the coming structural overhaul, you must stop tracking public headlines and start tracking the deployment of institutional clearinghouse risk models that require hard, unencumbered collateral to function. The technical mechanics driving this transition are rooted in the strict execution of international regulatory frameworks, specifically the Basel III liquidity coverage ratios that govern commercial banking networks. Under these modern compliance rules, banks are mandated to hold a specific percentage of high-quality liquid assets to ensure they can survive a 30-day systemic liquidity shock without government intervention. Historically, sovereign fiat debt satisfied these requirements effortlessly, but the accelerating degradation of currency purchasing power has forced regulators to reassess what constitutes true Tier 1 collateral. When a central bank updates its internal risk parameters, every commercial institution beneath it must instantly adjust its balance sheet configuration to avoid severe regulatory penalties. This constant rebalancing creates a structural demand for assets that carry zero counterparty risk and can be instantly liquidated during a market disruption. This is precisely where the intersection of physical gold reserves and advanced ledger routing protocols becomes an operational necessity for the survival of the global banking architecture. When physical gold is tokenized on a permissioned enterprise ledger, it ceases to be a dormant asset sitting in a subterranean vault and transforms into a dynamic, highly programmable liquidity instrument. Each token represents an unencumbered, legally verified claim to a specific weight of physical metal, allowing institutions to utilize it as real time margin collateral inside private clearing networks. Because the underlying ledger records every transfer with immutable cryptographic precision, banks can settle multi-million dollar margin obligations instantaneously without waiting for manual clearinghouse validation. This technical capability completely eliminates settlement risk, allowing the institutional system to maintain required liquidity ratios even during an acute debt market contraction. To fully grasp the magnitude of this structural upgrade, we must analyze the specific clearinghouse margin requirements that dictate how capital moves through the interbank market. When prime brokers and institutional market makers execute cross border trades, they are required to post initial and variation margin to central clearinghouses to cover potential default risks. If the value of their posted collateral drops, or if the clearinghouse adjustments increase due to market volatility, these institutions face an immediate mandate to supply additional Tier 1 capital. In the legacy system, mobilizing this capital requires liquidating other assets or borrowing through expensive overnight repo markets, creating a dangerous contagion loop. By integrating tokenized hard assets directly into automated liquidity routers, the system can dynamically reallocate margin balances across global jurisdictions in real time, preventing localized liquidity shortages from escalating into systemic failures. Furthermore, this programmatic collateral infrastructure operates on closed loop enterprise grade protocols that are intentionally insulated from public crypto market volatility. These systems utilize permissioned ledgers where every participating node is a verified, regulated financial entity, ensuring that institutional capital flows are never exposed to external exploitation or anonymous counterparty risks. The smart contracts governing these tokenized assets are engineered to automatically enforce compliance rules, tax obligations, and jurisdictional legal mandates at the protocol level. This means that an asset cannot move unless every regulatory condition is perfectly satisfied in real time, creating an unprecedented level of security for sovereign actors. Retail investors searching for public price correlation fail to realize that this institutional layer is built to operate independently of speculative retail volume, functioning as a private utility rail for global capital preservation. The strategic behavior of multifamily offices, sovereign wealth funds, and global custody giants provides the ultimate confirmation that the structural migration of capital is already underway. These elite entities manage generational wealth that is completely indifferent to short term retail hype cycles or speculative trading profits. Their primary objective is absolute capital preservation, which requires them to anticipate structural changes in global monetary plumbing years before they manifest in the public domain. Currently, these large scale actors are quietly unwinding their exposure to traditional commercial banking deposits and shifting resources into private custody frameworks backed by hard, tokenized assets. They are not preparing for a speculative market rally. They are positioning their core capital behind the programmatic checkpoints of the new digital financial architecture. When a multifamily office allocates capital into the digital asset ecosystem, it bypasses public retail exchanges entirely to utilize institutional grade custody platforms and private over the counter liquidity desks. These specialized access points allow sovereign scale entities to move billions of dollars into tokenized assets without creating immediate ripples in public spot prices. This deliberate lack of market impact explains why retail investors often see major institutional announcements followed by completely flat price action, leading to widespread frustration in the retail market. The reality is that institutional capital flow is structured to accumulate value privately within closed loop ecosystems before the public utility phase is officially activated. By tracking the growth of private institutional custody volumes rather than public exchange data, you gain a clear view of where true systemic liquidity is pooling. This private accumulation strategy is directly tied to the preparation for the Great Wealth Transfer, an event that will see trillions of dollars shift from legacy paper assets into digital infrastructure over the coming decade. Central banks and custody giants recognize that the traditional rails used to manage this wealth are too fragmented and expensive to sustain the velocity of modern global markets. To resolve this inefficiency, they are building unified tokenization platforms capable of hosting sovereign bonds, corporate equities, physical real estate, and precious metals on a single, interoperable ledger network. This structural consolidation allows institutional investors to manage entire portfolios of diverse assets with a fraction of the administrative overhead required by legacy systems. The true value of the underlying rooting tokens lies not in their retail speculative appeal, but in their operational capacity to serve as the universal connective tissue for this tokenized global wealth. To visualize how this institutional liquidity flows, one must look at the emerging cross-border settlement corridors being established between central banks outside the traditional SWIFT network. These bilateral settlement networks utilize private ledger infrastructure to bypass the political and technical vulnerabilities of legacy Western financial plumbing. When two sovereign nations agree to settle trade imbalances using tokenized reserves, they utilize a neutral digital routing asset to execute the transaction instantly without relying on foreign commercial bank intermediaries. This operational deployment creates a structural demand for specialized liquidity routers that can guarantee instant atomic settlement while strictly adhering to international compliance standards. This institutional utility loop is being systematically built out across global banking hubs, creating a permanent, high volume foundation for the digital asset economy that retail speculation cannot replicate. The transition to a tokenized collateral architecture is not without severe legal and structural friction, as legacy regulatory frameworks struggle to adapt to the speed of programmatic settlement. Traditional financial laws were engineered for a world of manual clearing, multi-day settlement delays, and physical paper documentation, making them fundamentally incompatible with real-time digital architectures. This disconnect creates a major policy roadblock, as central banks and commercial institutions must navigate a complex web of trailing liabilities and conflicting jurisdictional rules before fully deploying their technical capabilities. The current delay in public asset appreciation is a direct reflection of this regulatory friction, as legal frameworks are systematically rewritten to accommodate institutional capital compliance. A primary example of this structural friction is the ongoing debate surrounding bank custody rules and the balance sheet treatment of digital assets held for institutional clients. Under traditional accounting standards, a custodian bank holding physical or fiat assets for a client does not list those assets as liabilities on its own corporate balance sheet. However, early digital asset regulations frequently mandated that banks must list custody digital tokens as both an asset and a matching liability, significantly inflating their risk-weighted capital requirements. This regulatory obstacle effectively prevented major commercial banks from offering scalable custody solutions to institutional clients, creating an artificial barrier to entry for large-scale capital. The systematic removal or modification of these restrictive accounting mandates is a critical structural prerequisite that must occur before true institutional liquidity can flow unimpeded. In addition to custody rules, institutional actors must navigate strict Bank Secrecy Act and anti-money laundering compliance metrics that cannot be compromised under any circumstances. In a public, permissionless blockchain environment, assets can move between anonymous wallets, creating an unacceptable compliance risk for regulated financial entities that must know the exact identity of every counterparty. To solve this systemic liability, institutional developers are deploying advanced on-chain credential gating and automated identity verification layers at the protocol level. These technical solutions ensure that a digital asset can only be routed to a wallet address that has successfully passed complete international compliance screening. By embedding regulatory mandates directly into the smart contracts governing tokenized flows, the system completely eliminates the risk of compliance contamination, providing a secure environment for sovereign capital. This legal engineering process requires years of coordination between international regulatory bodies, central banks, and legacy clearinghouses to ensure total systemic stability during the migration phase. If a single jurisdiction updates its legal framework without aligning with global standards, it risks creating regulatory arbitrage or disconnecting its domestic banking network from international settlement corridors. This need for absolute international alignment explains why the rollout of the digital financial architecture appears slow and disjointed to external retail observers. The system is intentionally moving at a methodical, risk-managed pace to prevent unexpected clearinghouse defaults or legal vulnerabilities from undermining public confidence in the underlying infrastructure. Once these legal foundations are fully locked into place, the structural transition from legacy paper clearing to programmatic ledger settlement will become a permanent operational reality. Surviving and capitalizing on this macro plumbing overhaul requires a complete rejection of retail market strategies and a disciplined alignment with institutional capital preservation methods. The retail investor is trapped in a continuous loop of emotional trading, constantly reacting to manufactured news cycles, surface level social media hype, and artificial price suppression designed to flush out weak positions. To break free from this speculative trap, you must construct a systemic defense blueprint that treats digital assets not as trading chips, but as structural tools within a shifting global monetary architecture. This requires you to analyze the market through the exact same lens used by prime brokers, family office managers, and central bank risk compliance officers. Your first operational mandate is to decouple your investment thesis from public spot market volatility and focus entirely on the accumulation of assets that possess proven institutional utility. Look past the marketing narratives of speculative retail protocols and critically audit the underlying technical architecture to confirm it meets the strict demands of global clearinghouse networks. An asset capable of surviving the transition must feature enterprise-grade security, instantaneous settlement capabilities, and the programmatic flexibility to integrate seamlessly with legacy banking compliance frameworks. By allocating your capital exclusively to infrastructure assets that solve multi-billion-dollar friction points for institutional actors, you align your portfolio with the long-term survival of the global financial system. Furthermore, you must structure your personal capital storage and wealth management systems to mirror the risk mitigation strategies deployed by multifamily offices. This means utilizing secure, institutional-grade custody architectures, separating your long-term capital preservation assets from speculative accounts, and maintaining absolute operational security. Avoid the temptation to chase high-yield retail products that rely on speculative lending pools or unverified decentralized platforms, as these structures are highly vulnerable to sudden regulatory enforcement and systemic liquidity shocks. True wealth preservation during a global monetary reset requires prioritizing structural counterparty safety over short-term speculative returns, ensuring your assets remain unencumbered and accessible when legacy commercial banks face compounding pressure. The final component of your systemic defense blueprint is the continuous monitoring of institutional liquidity checkpoints, regulatory milestones, and central bank settlement integration metrics. Pay close attention to the implementation of international banking rules, changes in clearinghouse margin parameters, and the official deployment of wholesale digital currency corridors. These operational shifts are the true leading indicators of the global financial transition, providing a clear roadmap of where capital is being directed long before it reflects in public market valuations. By positioning your assets ahead of these institutional checkpoints and viewing the market through a data-driven macro lens, you protect your generational wealth from the volatility of the retail echo chamber and secure your place within the new digital financial plumbing.